Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are back with an Ask an Advisor episode where we get some of Australia's best financial experts in the room with us and put your questions to them. Today, we are joined by our mortgage broker, helped both Bryce and I get into our places, Chris Bates, founder of Alcove. Welcome back to Equity Mates.
Good to be here, lads.
Yes.
Looking forward to it.
So today we're going to be unpacking everything that you can do to boost your buying power, whether it's getting your first home or an investment property or even upsizing. We're going to be unpacking everything that's going on in the market and picking your brain, Chris, on how we can be boosting our buying power.
So really we want to, split it into a couple of sections. Understanding buying power, what are the ingredients that go into that secret sauce that the banks whip up, and then how we can improve how much we can borrow, clearing debt, improving income, all of that stuff. Then how we can boost our deposit. And then finally, we'll talk about, getting the right loan after we sort out all those ingredients. But let's start with understanding buying power as a concept. So what is borrowing capacity and how do banks calculate it?
Yeah, using a funny word there, buying power. I haven't heard that one before, but it makes a lot of sense.
It's our combination of like borrowing capacity and deposit, I guess.
Yeah, no, it's a good one. A lot of banks would say it's borrowing capacity, and that's sort of what, banks would sort of, call it, I guess. Really, when you start to unpack residential, not talking about commercial too much today, because that's a whole other probably episode, and it's a whole other way they go about it. But if we think about residential lending, so, buying houses and apartments and townhouses, etc., when you sort of get a few years down the journey in property, you realize that understanding what a good property, you sort of understand the fundamentals, right? It's like probably share investing, you understand what a good company is. And you start to realize that if you want to buy more of them, well, it's not more knowledge is going to solve the problem here for you. It's actually being able to borrow more money. So property is actually a game of lending. And so this is a really good episode if you want to really understand about investing in property, is actually understanding how do you borrow more money. And that might feel a bit scary when it's your first property, but once you start to get a few years down the line, you build a bit of equity and you feel more comfortable around your income and you build a bit of a buffer and savings and you go, well, actually, I wouldn't mind doing some more investing, whether that's in shares or whether that's in property. So that's sort of a long sort of context to the start. But borrowing capacity, every bank has their own way of doing it. It's not rocket scientists, sort of super complex. We get access to spreadsheets. That's pretty much what the banks have done it on for decades, right? And what they'll do is due to responsible lending guidelines, they have to basically make sure if they're going to lend you money that you can afford it. And so what they'll do is have to assess your situation, also validate it and basically, have evidence to back up that's your situation. And then they'll have an amount that they'll lend you. And so what they'll do is they'll figure out basically how much income you've got. And the way that they look at income does vary bank to bank. Some banks don't really want to go near casual or contracting income, or some banks will look at self-employed borrowers a little bit more fairly than others. They all want little niches that they want to sort of get a bit more appetite or a bit more market share in this little pocket of the market. And what they'll do is once you look at your income, they'll look at your expenses, which is mainly just your debts, really. That's the main thing they're concerned about, is that not only have you got home loan debt, but have you got car debts and credit card limits. And then they'll look at your expenses. And really, they'll have like a minimum living expenses that no matter what you declare, they'll use, which is called a HAM. Depending on the bank, they'll use just your customer declared living expenses. So basically what you just tell them, as long as it's above the HAM. And then some banks will actually go and verify, but there's very few that actually go and look at your bank statements and check what you're spending. So borrowing capacity in a whole is really just a bank saying, look, in your situation, based on your income, what your current debts are and what you're currently spending, this is how much money we'll lend you.
And so for an average situation, not including self-employed or whatever, just for an average situation, Is there a multiple at the moment, or like a general number that you can sort of times your income by to get your capacity?
I love little things, and you would have spoken about it for many years on the podcast, little numbers or little calculations that borrowers or, investors can use just to sort of get a on the paper napkin sort of number. And I think 5 times is probably a number to use. But to put that in sort of perspective, when I started in broking back in 2013 from the financial advice world, I was playing with the calculators and I was like, hang on a sec, if I go to that bank and then I put it on interest only and then we use NAB for this and that, we can get 10 times or 12 times or 14 times. So back in 2013, 14, that number could have been well over 10 times. And if you knew what to do, there were so many problems with the different calculators. An APRA came in and sort of told all the banks off in 2014, 15, but it used to be a lot more. And so lending's actually really tough now.
So 5 times is like a rough rule of thumb. Does it differ lender to lender? Like, are you getting wild swings based on where you go?
Look, if you're just an employee, you're on whatever salary, you don't get any bonus, and probably not, right? Okay, to buy a home. Like, it's going to be a very small difference. This is between banks, and this is where it gets a little bit hazy, right? So you've got banks, and then you've got non-banks, and then you've got private lending. So if we forget about private lending, where you're basically borrowing money off private lending, like that's just not usually what most borrowers are doing. But non-banks is sort of a growing sort of space. You've got people like Pepper, and those non-banks will be able to lend you at basically a lower assessment rate. So they can start to lend you some more money because they have different rules and regulations around the way that they have to assess your capacity. But for most people, with standard, sort of jobs and incomes, it does matter the incomes doesn't change much, but there is sort of quirks to their situation. So I don't know, they might have, some debts or some credit card limits, and different banks will look at that slightly different. They might be living at home and banks will look at notional rent a bit different. Some banks will look at your HECS a little bit different. So from an income point of view, maybe not. But then when you look at someone's situation, depending how other things in their life are complicated or not, then you start to find some quirks. And in the old world, when I would sit down with clients, I'd say, right, your borrowing capacity is 1.5 million. Hang on a sec.
Yeah.
I don't want to borrow 1.5 million, because it was 7-8 times their income. I only want to borrow $1 million. So borrowing capacity was never. There was always usually a lot of first-time buyers was too much. They didn't want to borrow that amount, or they didn't have the deposit to do so. But nowadays, often buyers are like, it'd be so nice if we had an extra 50 grand. And what can I do to get that?
Well, that's a great segue to digging deeper into what we can do to boost our borrowing capacity. As you said, there's 2 sides to it. There's your income and your expenses. And we'll start on sort of the expenses side of things with clearing debt. I remember going through my process of trying to get a mortgage, and there were a few, different types of debt that I had that were important to clear to improve my borrowing capacity. So let's start with the influence of personal debt, credit cards, buy now, pay later, those sorts of things. And also maybe if you can reference the impact of like unused debt on those. So if I have a credit card with a $10,000 limit, how is that like debt profile treated when it comes to borrowing capacity?
Look, the way the banks look at it is they'll just look at your limits basically, because the reality is you could borrow that money the next day or spend it on credit cards and go to JB Hi-Fi or whatever you want to do, right? So they will look at your limits. And a way to think about it, just really simply, is just whatever your limits are, times that by 5. That's what is roughly reducing your borrowing capacity.
Which is pretty significant.
Absolutely.
Yeah.
Absolutely, because every dollar matters right now for a lot of first-time buyers. And so the first thing is, if you're going to buy a home, really try to keep your credit card limits really low. The irony of the situation is, as soon as you sort of get your loan of formal approval and you settle, you can call the bank and increase your limits. And so it can just be a short-term measure. Like, that's just the reality of the situation. It doesn't really solve that. Car loans are the one that I think catches people out a lot of bit, because it can make sense depending on what you do for work is to get a car loan rather than using cash. And particularly for a lot of first-time buyers who haven't got much cash. But a way to think about that is that, whatever your repayments are, I think probably times are by about 120, right? So if your repayments are $1,000 a month for your car lease or car loan, that reduces your borrowing capacity like 120 grand. And so I'm probably what you call the bad guy, when I'm chatting to first home buyers, I'm going, right, how can we make this work? How can we, get them into a good asset, but maybe buy sooner? And we're going, right, look, you've got an $80,000 car. Well, that's probably not often, but sometimes. it makes sense, and their loan say 50 grand. I go, well, do you really need that car? Could you get a $3,000 Subaru just for the next couple of years until you buy a house? And that 30 grand would increase your deposit. And then also that $1,000 a month you're paying in repayments is just increase your capacity. And so be really careful just signing up to car leases and before you're trying to buy a house. It really does shoot you in the foot. And the irony is, once you do buy a place, you get a better rate on your car loan, and you can easily get a car loan once you own a property. It's one of their metrics.
Yeah. So a simple thing really is, if you've got the credit card side of things, is just shut it down.
Yeah.
What about you mentioned buy now, pay later? How do the banks look at that?
It's kind of like a repayment thing as well. I mean, we don't really see it too much now. I think like they've kind of really probably died down in terms of our applications, but that's probably another thing is, just really try to reduce those limits and don't spend too much on them.
Okay. Yeah. So I reckon the debt we get asked most about here at Equity Mates is HEX or help debt. How does that impact borrowing capacity?
Look, I guess, give you context, 2025, even yesterday I read a Domain article. Basically, there's a lot of pressure on the banks to try to increase borrowing capacity. We said it's 5 times now. We know prices have gone up over the last couple of years when, borrowing capacity's come down dramatically, which we can talk about. But there's a lot of, the bank cult are trying to force APRA to step in to reduce the serviceability buffer to push borrowing capacities up, right?
Well, yeah. I mean, you just do simple maths, and if median house price to median income is 8 times now, and then borrowing is 5 times, you're just at a structural disadvantage unless you have support from somewhere.
Well, that's exactly it, right? Shane Elliott, ex-CEO of ANZ, right, was very vocal on this, NAB, etc. So all the banks have sort of been talking through the media to sort of do this. HEX is one of those things that have popped up. And I think any advantages for first home buyers versus intergenerational wealth or the investor, I think it makes sense. CBA is probably the only one who've got a policy on this at the moment. If you've got a HEX and you can pay it out in the next year, then they'll basically set you on a lower assessment rate. So you can borrow a lot more money.
Yeah, I was going to say there was a pretty important caveat there, which is you can pay it off in the next year.
Yeah, and then there's another tweak on that policy in the next 5 years if it's going to be paid off. And so this is one of these moving targets. Before it was always included. Now it's a case of some banks are saying, well, do we really need to include that because it's going to be paid off in the next few years? And you're going to take a home loan on for 30 years. Do we really want to, really hit you as a first home buyer? And I think that'll change a lot in the next couple of years. More and more banks will start offering that.
And the government have obviously made noise about it and there's pressure there. But for you, if a client walks in your door or speaks to you on the phone tomorrow, how are you recommending they think about their HEX debt? With the uncertainty of what is to come still uncertain? So
for the last few years, we've actually encouraged clients sometimes to pay it off. The HEX rate, interest rate's gone up a lot, right? So the cost to have that debt's much higher than it used to be. And secondly, sometimes paying off that HEX debt is the difference between buying a property or even a better asset. And and they might have the cash to do so. And I mean, we'll probably lead to it later in the episode, but the 5% deposit scheme has really allowed people to maybe have a little bit more cash than they would have needed, a 10% deposit, and then that can pay off their HEX debt and allow them to buy into resi property, which is at a lower rate. And secondly, it might allow them to borrow a bit more and get a better asset.
Because the 5 times rule generally applies here as well, right? If you've got 40 grand in HEX debt times by 5, and that's kind of going to be the impact on your borrowing
It really
capacity.
looks at your income, because HEX repayments are based on the percentage of your income. And so the higher your income, the bigger percentage of repayments you're paying. So then it's a bigger benefit. So if you're on a lower income, then your HEX repayments lower, and then that doesn't hit you as hard. So rather than the balance, and so sometimes the repayment's really high, and the balance is really low, and you say, well, let's just pay the balance off, and then you'll get a huge boost to your borrowing capacity.
True.
And so it is one of those things where you probably just do your numbers, but that's when some lender like CBA right now, even though we don't do too much with them, is a good option. And I think more and more lenders will start offering those advantages.
Yeah.
Well, if you want to do your numbers, you don't have to do them yourself. You can head to equitymates.com/advice and ask to speak to Chris and the team at Alcove, and they will do the numbers for you.
Yes.
Very good service.
Yeah.
They did the numbers for Bryce and I. We didn't have to pull out the spreadsheet once, although Bryce probably did.
Lots of spreadsheets.
He's a sicko that enjoys it. Yeah. You look at the spreadsheets. Okay, so Chris, I guess for people who have debt, be it HEX, be it consumer debt, be it a car loan debt, that they can't easily pay out, I guess we want to close this section by asking what are the strategies they can employ to make the best of their situation. And some of the examples might be like joint applications or guarantor loans, but I'm sure you know, I'm confident you know more than we do. So like, how do you advise clients who do have some debt that isn't easily cleared?
Look, it depends on whether that debt's really affecting their application or not. So like they can still borrow what they need to, then is there really a pressure to pay that debt off? Maybe not, right? Like, I mean, there'd be a preference because it's a higher interest rate or they just don't want that extra repayment. But you're right. Sometimes, you can't get rid of that debt. And so, guarantor loans and things like that really just help you buy without a deposit, basically. You could even have zero deposit and they'd even pay you stamp duty in some cases, right? And so that might be a good scenario where you go, well, I'm going to use my cash to pay out my debts and I'm going to use a guarantor loan to allow me to enter the market. That's an example. I mean, sometimes there's these things called common debt reducers where, couples will buy in one name and then the other debt will be in their partner and things like that. Really, I guess the question is whether that debt's really hitting them hard for their borrowing capacity. And if it's not, then there's probably no real rush to pay it off.
Nice. Well, Chris, let's move to the other side, which is the income side, improving, I guess, your financial profile and your serviceability. So what are some ways that you're seeing clients boosting their income at the moment? Like how do lenders view things like the gig economy or side hustles or, being an umpire on the weekend, podcasts? Like, is that something that can drastically improve your borrowing capacity?
The way to think about income is you've just got to be really careful about when you timeline out your life and your property decisions. Don't be rushing to change your income if you're then going to look to, for example, need to borrow money. And so you've got to be really careful whenever you're making major employment changes is if, yes, you can get a pay rise, but does that mean then you've got to wait a year or two till you get your first bonus? And is that going to really shoot yourself in the foot? You might have a higher salary and your OTE might be higher, but that might reduce how much you can borrow. So I guess when you strategically look at when you're going to make property decisions, it's not really like share investing where you can be in and out of markets at any point. Most people make property decisions at, every few years or even 5 or 10 years, etc. So you just got to be, whenever you're thinking about switching jobs, you just got to say, well, how would this affect my borrowing capacity? And a lot of people don't ask that question. And then because that might mean that, you get a high salary now, but if that means that you won't be able to borrow an amount you want to next year and it's going to take another year till you get that bonus, then you have to ask, there might be an opportunity cost from that.
How many pay slips or how long does a bank want to see a certain level of income before they're willing to lend against that income?
So salary income's really, banks really do not discriminate on it, particularly if you're staying in the same industry, you're going from one role to another role. You won't have to wait till you go through probation. It's kind of one of those myths. Sometimes they might ask questions, but depending on the concern around the economy and which job you're switching to, if it's completely different to what you're doing, they might want to see a bit more runs on the board, like 3 or 6 months. But generally, most people aren't doing that, right? So if you're starting, from one job to another, you don't have to worry about probation, a couple of pay slips and you can borrow. But bonuses and commission, they do look at that a bit different. Some banks will lend on, 1 year's bonus. Some will want to see the average of 2. Commission, sometimes they'll just lend on averaging it out for this financial year. And so whenever you're in that type of world, you've got to be really careful, switching jobs. Some banks will even lend on sort of guaranteed bonus if you've got a really strong, like in investment banking or something like that, where you've got a real strong history of bonus performance. So this is where we kind of often have to ask for exceptions at the bank. So this is where you've got bank policy, but we're lodging this. It might not suit the policy, but then we say, look, this is your mitigating risk, right? We don't see this. You should put an exception on the file because they've got 10 years of bonuses getting paid out at their last job, and they took this role because it was likely to be a good step for their careers and things like that. So now self-employed and businesses, like if you asked about gig economy, etc. Look, you do really need to be careful when you go self-employed. The reality is banks do start discriminating against you. You need a couple of years to have an ABN. Often you need a couple of years of financial, tax returns. Now, it doesn't mean they'll always take those 2 years and average it out. A lot of the banks will know startups are growing businesses and they'll often just lend on your last year. But whenever you're starting any type of business, even if you have a good first quarter, that doesn't mean you can borrow on it.
What if it's in conjunction with a full-time paid salary job? Like I'm working full-time here at Equity Mates, salary, bank's happy. I'm also then earning side income through the gig economy or even dividends through shares, those sorts of things. Like how is that? Is that a massive boost, or
investing income, which we can talk about that as a whole, like shares or property. We can talk about that as a separate one. But whether you're starting a side gig or you just want to do a bit of contracting off to the side, it really depends on what it is. If it's like a contract and it's like, you know what, this is a 6-month contract and it's, you know, and sounds feasible to the bank that you could do that alongside your work and you've done it before. Contracting is one of those ones where they're just a little bit nervous because they're like, well, you've never done this before. But if you've done contracting and you've got a couple of tax returns to show you've been doing it for 4 years alongside your job, they'll be fine with it.
Yeah.
I mean, a gig economy, you just got to think from a bank point of view. Like, they're just going to look at it and go, how sustainable is that?
Yeah, the reality
and, you know, if you've been doing it for a week, is the bank going to lend on it? You know, doing it for 6 months and then you've got a tax return to prove it? Yeah, maybe. Okay. And it's one of those ones where it is a maybe. And often in those situations, this is one of the big benefits of a broker because we're looking at it and going, that's not going to fly. That might fly at this bank. I'm going to call the BDM. I'm going to check them. Will they sort of, give us the okay? Yeah, okay, cool. We don't just lodge it with a bank and go cross our fingers, mull on the wall approach, affect your credit file. Then we go, it was never going to get approved anyway. We could have just made a call just to check.
Yeah.
There is a grey. There's bank policy and then there's bank policy that, you know, can get like an exception on file.
Between income and expenses, if you're just looking at someone's finances as a whole, what are some of the like common red flags that you'll see or that a bank might flag when they're just reviewing someone's total situation?
Look, credit file can catch people out. Like there's the guy or girl who's gone and tried to collect all the credit card points and have lodged, 10 different applications at credit cards over the last couple of years. And as long as they've been paying that off, their banks aren't really concerned. They just say this is just a point collector. But as soon as you start missing payments and your overall, it looks like you're lodging applications all over the place, it does give your file a bit of a bad smell. And so, and the key thing is if your credit score goes under sort of 700. So, if you're thinking about doing any property transactions or borrowing money, just go and get yourself a credit report, right? Just see if there's any issues on it. That would be my first sort of tip. I mean, red flags after that. I mean, to be honest, they don't even really care if you're switching jobs a lot. That's fine. It's just the way that we work. But they are a little bit nervous if you're switching, to a contract from employed. But then they go, well, depending on the industry you're in, they'll be like, well, that just seems normal in that industry. And so they're more comfortable in certain industries than others. So there's nothing really red flags from a way that you save money. I mean, often a lot of first-home buyers, you really do need a genuine savings. And so if you rock up the door and say, I want to buy a property and I've got $30,000 in my account, and they see, your bad savings habits, for example, and that money's just got there yesterday, there is like a genuine savings sort of element that they need to see you have saved 5% deposit over the last few months.
Are there any categories of spending that banks will take a look at? And what I'm thinking there is sports betting, Bryce's smoking habit.
Gambling has caught us out. Yeah. Okay. Yeah. So you definitely have had clients where they've asked questions about it. Doesn't mean your loan's not going to get approved, but that is one that, sometimes banks are, depending on their green rating on whether they want to support that or not. And so that was something I would try to limit personally. I'd also just, it's just a best practice, right? The way I do it, I've got one bank, like a digital bank that I do my day-to-day spending in. And then I have my home loan offset account that I put money into to pay those mortgages. And then I have a separate bank where, I pay a salary to. And I might pay other just, fixed expenses out. So you might have, best practice of someone might be is to have their day-to-day spending at, an ING, for example, right? They might have their income goes into a NAB account and then they might have a mortgage at St. George. And I think the benefit of that is when you go to borrow money, St. George don't really see what's happening at ING, right? And then NAB, they only need to check NAB to verify your income and what maybe your rent is or whatever it might be. I guess when a bank's looking at your situation, the less they sort of have in front of them sometimes helps you in terms of an application. Whereas if you do it all at one bank and then you go back to that bank to say, I want to borrow some more money, they're going to see everything. And it's really up to the assessor's choice whether they look at everything.
Well, Chris, we're going to take a quick break. And on the other side, we're going to talk about how we can boost our deposit. So we'll be right back. Welcome back to Equity Mates. We're here with Chris Bates, founder of Alcove. Our mortgage broker helped Ren and I both buy our first property. If you'd like to speak to Chris and the team, head to equitymates.com/advice and fill out the form there. We'll make sure we put you in touch. Chris and the team are great at not just helping you with the mortgage, but also strategically talking you through everything that you need to consider before buying your first home and which properties to buy as well. I found that incredibly useful. But Chris, boosting your deposit, there's plenty going on at the moment. The government it's sort of front of mind for government. But before we get into that, what's the sweet spot for a deposit amount when it comes to things like avoiding lenders' mortgage insurance and also like getting the sort of the best rate possible?
This has all changed over the last 4 or 5 years. Pre-government schemes, which we'll talk about next, but we'd always try to get clients to at least a 10% deposit, ideally a 12% deposit, and that would really reduce the cost of lenders' mortgage insurance. It wasn't the 20%. If you had a 10% deposit, the LMI was roughly 2%. If you got to a 12% deposit, maybe it was like 1.5%. And so, and it wasn't paying 3 or 4% for this lender's mortgage insurance. So that was kind of the old world. The government, I think it was back in 21, came up with this 5% deposit scheme, and it's been a big success. There was income limits on it. There was price point caps in different cities around the country that really limited the amount of first-home buyers that were eligible. But then that worked. I guess it gives a bit of a help start to first-home buyers. And then they've come in with the election recently and said, look, we're going to expand that scheme. And the expansion, which starts in January, basically means any first home buyer, no matter what income and really whatever price point you want to buy at within reason, should be able to buy their first home with a 5% deposit. And that's still at a good rate. It's not paying it's slightly higher than what you would maybe get if you have a 20% deposit, but it's not astronomically more where you're paying a lot more in an interest rate, which was kind of like paying LMI anyway. And that 5% deposit scheme really changes the game. And what it means is, there was an income cap of, say, if you earned over 120 or 125, but if you're on 150 now, then you're eligible, right? If you wanted to buy at 1.1 million in Sydney as a couple earning 220,000, last year you weren't eligible, now you are. And I think that's kind of gone a little bit off the radar with the news over the last few months since the election. But I think you'll start to see it everywhere in the next few months because January is going to come around quite quick. And that's going to be really, if you are a first home buyer, it's one of those things that you're probably going to, if you don't take advantage of that and you want to buy 6, 12 months later, you're going to kind of maybe a little bit late to it. I feel like it's one of those things where you want to be ahead of the curve, not after it.
Just to unpack that thinking there, when you say you'll be a little bit late to it, is the implication that the price point of houses that first home buyers are sort of trying to get in is going to see a big bump up because everyone's going to take advantage of it early and then it'll be out of reach for those who try and take advantage of it late? Is that what you're saying?
Yeah, exactly. So the reality is a lot of first home buyers are buying what other first home buyers are buying. It's just naturally, right? A lot of them are similar ages, have similar desires in terms of what they want from properties, and there's certain pockets in certain cities that first home buyers are naturally going to gravitate towards first. Because of these price caps. So in New South Wales or Sydney, it's 1.5. In Melbourne, it's $1 million. In Brisbane, it's $1 million. Just talk about those 3 cities. So if you think about it, a lot of the properties under $1 million in Brisbane and Melbourne that suit young couples and families are going to be where a lot of first home buyers go, particularly if it's, in a more of an inspiring, affluent sort of location that they really want to enter. And they couldn't enter there now, but they can in January. And so the other thing is that it doesn't take a rocket scientist to figure out what investors are going to do as well, right? There's been a regional play for the last few years, higher interest rates, higher rents. It sort of made sense. But a lot of investors are now saying, well, I want to take advantage of this. I know where the first home buyers are going. I'm going to buy there as well. And so what you've got is investors are going to compete with first home buyers at these certain pockets in our capital cities and investors are already doing it now. You talk to buyers agents in Melbourne and a lot of investors are buying at 800. They're trying to get ahead of this wave of first home buyers. And the same will be happening in Sydney. A lot of investors are saying, well, I could buy at 1.6, but why don't I buy at 1.2 and then take advantage of first home buyers entering over the next couple of years?
So that's the 5% deposit scheme. What other government schemes should we be aware of?
If you're eligible for that, there's really been realistic. That is just such a good scheme.
Yeah, okay.
It's like I was shouting a little bit because I'm a little bit against putting, not solving the big issue, right? Which is, really having a good structural long-term solution on unlocking sort of more housing options for, buyers of the future, right? And I think, hats off to Chris Minns, what he's doing in New South Wales right now. We're basically rezoning, and I think that was a real brave thing, taking on the NIMBYs. But that's part of the solution. Part of it's build to rent. There's so many solutions that we need to unlock supply. So if you just keep giving more money to first home buyers, all you're doing is kicking that can down the road. And whether it's a first homeowner's grant, a home equity scheme, or a 5% deposit. But I also say that a lot of first home buyers really need to enter. And if you haven't got intergenerational wealth, you're at a huge disadvantage. And so this allows people without intergenerational wealth to actually buy with a deposit rather than having to wait till they save a 10, 15, 20% deposit and then everyone else making the money and then them just entering later.
Yeah.
The problem is, though, all you're doing is bringing forward future demand to today. So you're not really solving the problem. So if you're eligible to that, then I personally wouldn't consider a home equity scheme. I think you're giving up equity value. You might have a smaller mortgage, but there's a lot of rules around that. You wouldn't pay LMI. So you look at the share prices of some big LMI companies, you can see that that's been a huge issue for them. You wouldn't use any of those. There are some grants for buying certain types of new property, but buying new property is often not really the best investment. Particularly if you can buy an established property that's more scarce and is likely to go up in value more just due to the realities around supply.
The challenge is also, you say you put a 5% deposit on 1.5 mil, you still got to borrow the remaining 95% and service that. Like, that's no easy feat.
Yeah, it isn't. But that couple on, say, 250, maybe say 270 probably could, right? That wasn't an option before. Before they needed a deposit of, maybe they needed 12/17% deposit, right? Because you have to pay stamp duty. So you're looking at maybe like 280 grand. Now they need 5%, so 75 plus they need 150. And a lot of people similar when Dominic Perrottet changed the rules around stamp duty a few years ago, and he said, look, first home buyers don't have to pay stamp duty up to 1.5 million. A lot of people are like, well, that's not going to change prices. Pretty much within weeks, properties that were selling at 1.3 were selling at 1.5.
We were trying to buy at that time, and there was just a bottleneck at 1.5. Everyone was just bidding up because they're like, "We'll stuff it. We know we can bid it up to 1.5, and we're going to save X amount on stamp duty by doing so." And so, anything that was 1.1,
the smart bid
was just ridiculous.
Then was to bid 1.5 at auction.
Yeah.
So if this property's going to go, only one person can bid 1.5. You bid 1.5 and $1, you're over it.
Yeah.
So, opening bid 1.5.
Did you do that at all?
Well, no, that's because you knew it was going to get there anyway.
1.5.
And the only chance of getting it. And you can see that because there's so many properties sold at 1.5 on the nose.
Yeah, on the nose.
Because if you went $1 over, the first home buyers couldn't buy
Missed it,
Yeah. Oh, that's interesting. Take advantage of the 5% scheme if you can. If you can, then a lot of these other like shared equity schemes where the government owns part of the home, don't worry about them. I'm trying to think of other schemes that can help first home buyers boost their deposit. And the one that comes to mind is the First Home Super Savers scheme. What do you think about that one?
Oh, similar to the 5% when it first came out. I was, it was, I'm not sure if it was Morrison, but I remember just coming out and I was screaming because I've just from an advice background, I just don't like mixing super with, property. And I'm not a fan of accessing super to buy property. I do think it's inevitable. I think, it'll be whether it lives in the next election or the next election after, it'll be one of the things that they'll do, and people will use their super to enter their first home. Like that'll just come at some point. It's just part of the property Ponzi, you call it. But the first home super saver scheme can make a big difference, particularly if you're a couple. And, if you do it over a number of years, there is limits on how much you can put in per year. I think it's 15 and maybe up to 50 grand for an individual. So 100 grand as a couple. And there's a tax saving in doing so. Once you understand that arbitrage in this tax saving, it makes sense. It's unfortunately, though, people don't know about it till it's maybe a bit too late. And there's an advantage depending on the time of year when you're doing it, and you can save a few grand in tax and you can consider it. But it's really a long-term strategy. So if you're 3-4 years out and you're trying to build your deposit, then I think you should definitely be considering it. Just be really careful around understanding the rules around getting your money out. I had this concern straight away. How's it actually going to work? How's the calculation? How long is it going to take? And they've changed the rules there where if you don't even ask to get it out prior to signing a contract, so you basically have to ask for a letter. If you ask that letter after you've signed a contract, then you're considered a buyer. So be really careful. You can get yourself caught out there. And there are some issues where, people have asked for it out and they haven't taken it out, and then it gets stuck in there if you don't buy. So just really understand the terms and conditions and just try not to. The reality is if you end up leaving money in super and you leave it in there for the next 30, 40 years, you're probably not going to regret it. It's in a low tax environment. It's going to compound for you.
Yeah, it's just if it's like 80% of your deposit and then you can't get it. Yeah. Okay, interesting.
Are there any other strategies, Chris, that you that come to mind when it comes to boosting the deposit?
I mean, it's just generally like saving your cash, right? Is just getting a system there, right? And, and trying to basically, sell cars. Like, it's just these sort of things. Rattle the tin. It really is. It really is. Rattle the tin. Just try to get, because with this 5%, and most people are going to be eligible for that. And if you can get just to that 5% deposit, and a lot of stamp duty concessions in different states right now, I reckon we'll see some changes with that as well, that more aligned to the government scheme. Victoria have talked about that. And so really, it might be that you can buy in Victoria up to $1 million, but not pay stamp duty. You only need a 5% deposit. You're at 30 grand, you only need an extra 20, you might be able to rattle the tin around family to get there, right? And so that would be the main thing, just having a system and process on how you save. There's always disruptors in the mortgage market trying to take advantage of niches. That's just the reality of lending, whether it's non-banks or private. But there are some sort of new sort of first home buyer, small, deposit sort of lenders coming in as well, which sometimes they work, and we've had to use them as well. But that's really a case by case.
So, Chris, if I just sort of recap where we are in this episode, we wanted to understand how we could boost our buying power, and we started by talking about the borrowing capacity side of it and how we could increase our serviceability, clearing or minimizing debt, thinking about increasing income and managing our expenses. Then we spoke about ways to boost the deposit, and to my mind, they're the main levers you can pull: deposit and borrowing capacity. There's one more lever which I'm not sure how worthwhile it is to unpack, but I'd like to get your thoughts, which is the actual loan structure and like how much that changes how much you can borrow and therefore how much you can spend to get into housing. So do different loan products or different loan structures affect your borrowing capacity?
Yeah, absolutely. And I think this is where strategically, often for a lot of first-time buyers, but, at all stages, we have to sort of talk through, if you bought your place as an investment property, versus buying something to live in, how does that change how much you can borrow? And often it is different because you've got a rental income, depends on what you're paying in rent. And you go, well, I'm not even actually paying rent because I'm living at home. Or I am paying rent, I'm on the lease and it's just my name on the lease. So a bank's going to use the full rental amount, not just the third of the rent I'm paying. And so I guess, and then you might say, well, I need to get out of that lease, right? And that allows me. So absolutely, whether you buy it a home or investment changes it. But then also you might say, look, I want to buy it as principal and interest. I want to do interest only. And interest only usually reduces how much you can borrow, because what a bank says is, look, at some point that interest only is going to end, and then you're going to have to pay your loan over 25 years, not 30. Look, there are some lenders, and I think this is another thing that's inevitable. A lot of people who are anti-property will be shouting at this, right? But it's just, I think this is just the reality of a system, right? Like when a system's heavily weighted towards an asset class and society, there's always a desire to keep pumping prices up. And what we will see is longer term loans. I mean, you wouldn't have thought 40-year loans would have happened a few years ago. Now there's 40-year loans on the market.
Oh, there are?
Yeah.
Okay.
And I think that'll start to become more and more mainstream. There's countries around the world with longer loans than that. That affects it as well. But reality is most loans will get set up on 30 years. And so you're not really tinkering with that. You just go straight to the max. You could always pay your loan off under, in 3 months if you wanted to. That's your choice. You're not tied to 30 years. So most likely it's usually around that investment versus owner occ, and that really, some of those numbers do change. And often people are saying, well, I don't really need to live in it now. If I buy it as an investment, interest rates are a bit higher. From a cash flow point of view, I'm happy just to rent it out for a few years. I'll just keep renting. I'll be a rent investor. That means I can spend $800, not $600. It also means that I don't have to worry about the mortgage myself. I've got an investor paying for that. And then secondly, that interest only thing, you just got to be careful because, going principal and interest, you save yourself on interest as well. It's a lower rate, which is a good thing, but you do find that your repayments are a bit higher. And so you can get yourself stuck where you borrow, you go P&I, that lets you borrow a bit more. And then you've got a higher repayment, and then you can just find yourself. And you also got to be careful having principal and interest on anything that's ever going to be an investment property. You just don't want to pay off that debt. Exactly.
Yeah, no need. What about for the non-bank lenders? Like, do they generally allow you to borrow a little bit more, or is it more sort of niche opportunities for them.
Yeah, this is it's been an explosion in non-banks. The reality is if you type in AFG index into your computer right now, you'll find that they do get very little market share. The big four absolutely dominate, and then the Macquarie probably, you add that in there as well. So the big five, shout out to Macquarie, but they pretty much take 90% of the loans, right? And ING will get a few percent and a few others, etc. So the non-banks are getting very little market share. So we've always been very apprehensive recommending non-banks. We've not just been broking for a year. We've seen at times when customers get burnt, when market cycles change. And it made sense at first. Oh, it was a good rate. And it meant I could borrow more money. And then all of a sudden, something changes to the world economy or interest rates or borrowing capacity or their situation, and they can get stuck at a non-bank, often paying a higher rate with not really the best retention pricing. So you've got to be really careful using non-banks. But sometimes you might use them because you can borrow more money. So if you're an investor trying to leverage up to the nth degree, you go, well, I'm willing to gamble on that because I reckon I can refinance that loan in 2 or 3 years' time back to a big bank. And the way they can do that is they use a lower assessment rate. So, 2% versus, say, a 3% at the banks. And that gives you maybe an extra 10% borrowing capacity.
Chris, just to close it out, I guess some concluding questions for people who are, wherever they are on the property journey. I think at this point in Australia, everyone's trying to find ways to boost their borrowing capacity and their buying power. So what are some of the biggest mistakes you see from buyers who are trying to eke out that extra, extra increment to buy more?
Look, I think sometimes they are too holding on to the car or the credit card, or they switch jobs, which we sort of spoke about before. They don't explore lenders. They don't know. They just sort of all of a sudden just go to their bank, or they structure their loans in a way that it's like cross-secured and they can get themselves tied up in a bit of a knot. So there's heaps of different structuring issues they might have. I guess it's also been just playing a bit of apathy and not taking care of their credit file and not building buffers when they can. So, you've got to really be strategically going, for example, on the way here, my sister, we're strategically doing a reval, just done a reno, right, let's do a val at 3 different banks, let's build some buffers again. You know what I mean? So I guess it's like having a mortgage strategy that they're sort of constantly reviewing and setting themselves up years often in advance for their next property decision. And so I think that's where a lot of broking probably needs to get a bit better. I think it needs to move into more of a trusted advice profession and more strategic in saying, okay, I know you want to do this, but what's likely to happen after? What's your next property move? Can I structure things today so you're going to be in the right position? And that takes a bit of planning. You really need to understand tax. You really understand, have longer conversations around what their longer term plans are and how they're going to change. And so that's what I would say. It's just not having a mortgage strategy, and constantly tweaking it and reviewing it, and maybe just doing a sit and forget. And then all of a sudden there's a loyalty tax they're paying, just by sitting on their hands.
What do you tell your clients when it comes to someone wanting to just borrow the maximum they can, but also, ensuring that there's borrowing safety around it or doing it in the right way?
So the borrowing your maximum you can does come up. There's naturally a conservative part of the population and there's more of an aggressive part, right? And so I think it's just really having I did this week. There's a client who's doing really well in a tech firm. You can see she's naturally very conservative, and the problem with that is that they might not even get the right property they want because she's so fixated on spending a certain price point that probably not going to get the lifestyle benefits they really need out of a property. That'll give them a shorter runway. They might have to pay buy and sell costs again. They might actually not get a great asset for that. They might get the bottom of the market or a busy road. And even if she was just a little bit more aggressive, I guess, in terms of her price point, there's still a way to structure things to give them huge buffers. So in this situation, they were scared around a debt number, right? I don't want to have a debt bigger than this. And we're like, well, no, you could have a debt bigger than that if you've still got a bunch of cash left over that you can put in offset account. So yes, it's a bigger number on the internet banking, but you'll feel better because when you sleep at night factor is you go, I've got 300,000 in the offset account. It was actually much bigger number for that client. So structuring your loans and making sure that you're always thinking about your buffers, not so much the actual loan amount. In that situation, someone will go, borrow at your max. Okay, yeah, you should, because the rest of the money should go in your offset account, assuming you're not paying lenders' mortgage insurance and things like that. That's the key. Whenever you take on debt, you want to know that you're protected if things go wrong. And sometimes it's worth, for example, paying lenders' mortgage insurance if that gives you a buffer. Or sometimes it's worth paying 80% LVR sort of interest rate versus a 70% if you've still got an extra 10% in your sleep at night factor when you look at your offset account. And so that's what a good mortgage strategy does. It protects you. And sometimes you go, well, I don't need to. I want to keep that capacity for other investing, whether it's shares and I can get a great house I'm happy in. It's a great investment. It's at this price point. I don't need to spend more, and I'd rather keep that capacity for other investing.
Well, Chris, I think my big takeaway here is you need a mortgage strategy. So if you don't have a mortgage strategy or you want to upgrade your mortgage strategy, head to equitymates.com/advice. We'll put you in touch with Chris and the team at Alcove. The good news is there is no cost to speak to a mortgage broker. So have an obligation-free, cost-free chat with Chris or the team, upgrade your mortgage strategy and boost your buying power.
I love it.
Chris, thanks for joining us today.
Awesome. Thanks, guys.
Thanks, Chris.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.